How Warren Buffett built his empire. How did Warren Buffett build such a massive empire that he bought entire companies and ousted their owners? Yet many people didn't believe in him. When he applied for his master's after getting his degree in business administration, he was rejected by Harvard University. But one ethic in Warren's life put him under immense pressure. If you belong to a middle-class family like me, then everything I'm about to say will deeply resonate with you. Every middle-class person dreams of becoming rich, earning money, and giving their family the happiness they've always wanted. But after facing so many struggles in life's journey, deep down, you start to feel like, to become wealthy, you either need to be born in a rich family or have great luck. However, Warren Buffett's story proves all of this wrong. Warren Buffett is one of the richest people in the world today. If you look at his current net worth, it's about $135 billion. He is an incredibly successful investor, often called the Oracle of Omaha. But the question remains, in a world full of people diving into the stock market where thousands fail, how did Warren Buffett build such a vast empire? In today's video, we'll learn how Warren Buffett understood the stock market and how he became a self-made investment icon. So, let's start from the beginning. Warren Buffett was born in Omaha, Nebraska on August 13, 1930. Just a year before his birth, the Great Depression had begun in the country. During his early childhood, he witnessed how people were struggling immensely to even sustain their daily lives. Despite all their struggles, they couldn't make ends meet. From a young age, Buffett understood the value of money, much earlier than other kids his age. His father worked in a bank, but due to the Great Depression, he lost his job. Yet thanks to the savings he had accumulated over the years, he started his own business, where he sold stocks and bonds. Warren was a shy and quiet child who spent most of his time reading books in his father's library. His father's library was filled with books about investment and business, which is likely what sparked his interest in these subjects. To put the knowledge he gained from these books into practice, Warren talked to his grandfather, who owned a grocery store. At that time, Warren Buffett was only 6 years old. Warren's grandfather wondered what job to give such a small child. Then, he noticed Coca-Cola bottles on the side and told Warren to sell them door to door. That's how, at just 6 years old, Warren started his first business, selling bottles door to door. For every 6 packs sold, he earned 5 cents, which, by today's standards, would be around 3 or 4 rupees. Gradually, he also started selling chewing gum, magazines, and other small items. And you won't believe this. At the age of just 11, Warren pooled together all his savings and bought 3 shares in an oil and gas company called City Services. The price of 1 share at that time was $8.50, which is approximately $323 in today's value. But soon after buying the shares, he received a huge shock. Their price plummeted, and Warren was deeply worried. He remembered something he had read in a stock market book. The stock market is a device for transferring money from the impatient to the patient. In other words, if you want to play the long game in the stock market, you have to maintain your patience. Warren decided that he would only sell his shares when their price reached $40. Otherwise, he would just let them sit there. Months passed by, and one day, while reading the newspaper, Warren checked the stock price again, and to his surprise, the shares he had bought for $8.25 had risen to $200, about $750 in today's terms. This small incident convinced him that the things he had learned from books could be applied in real-life situations. This combination of experiences and mistakes made Warren smarter and more intelligent than other kids his age. Sometime later, Warren's father was elected as a U.S. congressman, and because of this, the family moved to Washington, D.C. After moving there, Warren started delivering newspapers for the Washington Post, but unhappy with his earnings, he also began delivering papers for the Times-Herald. With these 2 jobs, he earned about $179 a month, which is around 994 rupees in today's terms. Soon, Warren came up with another business idea. Using his earnings, he bought a pinball machine. Pinball is a popular game, especially in Western countries, and you might have played it on your PC as well. He placed the machine in a hairstylist's shop and then partnered with a friend to place 2 more machines in other locations. People played on the pinball machines throughout the week, and at the end of the week, Warren and his friend would split the profits. Initially, everything went well, but after some time, they realized that the money wasn't coming in as much as expected. So they sold all the machines for $1,200, and with that money, Warren bought his first piece of property, a 40-acre plot in Nebraska. You won't believe it, but Warren was just 15 years old when he bought this property. And even more interesting, he bought his first stock at the age of 11 and filed his first tax return at 13. After high school, Warren wanted to become a full-time stockbroker, but on his father's insistence, he joined the University of Pennsylvania. He used the rental income from his Nebraska property to pay his college fees. After completing his business administration degree, he applied for a master's program, but he was rejected by Harvard University. After the rejection, he enrolled in Columbia Business School, where he met famous investor Benjamin Graham, whose writings had already inspired Warren. Benjamin was a professor at the time. After his master's, Warren took a closer look at himself and realized that he was still a shy, introverted person who struggled not only to talk to new people, but also to present himself in front of others. So he enrolled in a public speaking course. Even today, Warren says that if you ask him about the best investment of his life, it would be that public speaking course. Sometime later, Benjamin Graham offered Warren a job at his investment firm. After working there for a while, in 1965, Warren left the job and returned to his hometown Omaha to start his own company, Buffett Partnerships. He converted his bedroom into an office and managed the entire business himself. Warren used a very smart strategy. He bought shares in companies that were about to go bankrupt at very low prices, ensuring that their liquidation value was higher. If I explain liquidation in simple terms, it's a process where a company is dissolved and its stocks and assets are sold, with the proceeds distributed among creditors and owners. Warren called this strategy the cigar butt approach. In Western countries, it's said that a person can enjoy a few free puffs from a cigarette butt found on the ground. He applied this concept to companies and turned it into a winning strategy. His strategy was simple. Find companies whose shares are selling at extremely low prices, but are actually worth much more. This method proved to be a masterstroke for him. In just a few years, the net worth of his partnership grew from $15,000 to $7.2 million, which is roughly 87,90,000 rupees to 60 crore rupees. However, despite Warren's success, many people still didn't trust him because he was just a teenager and looked like one too. Who would trust a teenager when it comes to money, right? For the next 5 years, Warren managed his business entirely by himself. He wrote checks, delivered stocks, and even filed his own taxes. But those who trusted and invested in him saw a 29.5% rise in their portfolios. And a 29.5% rise is no small achievement. Time passed, and after 10 years in business, Warren was managing $44 million in assets. Just 3 years later, this number grew to $104 million. While all the investors were happy, one principle in Warren's life caused him great tension. Be fearful when others are greedy, and be greedy when others are fearful. This means that when the market is bullish, i.e., when stock prices are rising, everyone rushes to invest. What happens is that the price of a stock increases far beyond its actual value. That's when you need to be cautious. Conversely, when the market falls, stock prices drop below their true value. That's exactly the time to be greedy and buy the stock wisely. Because of this philosophy, while others celebrated when the market was high, Warren became quite nervous. He quickly realized that a bull market doesn't last long, and he couldn't afford to break the trust of all those people who had invested so much money in him. That's why, in 1968, he decided to dissolve his business, even though, at the age of 39, he was worth $25 million. And this is where Berkshire Hathaway enters the picture. Berkshire was a struggling textile company, and its stock price had fallen to $7 per share, but its assets were worth more than $11 million. Warren smartly bought as many shares as possible at $7.50, and 3 years later, the company's owner sold his remaining shares to Warren. But when the final offer came, the owner tried to cheat Warren. Realizing this, Warren was furious and decided to buy the entire company, kicking the owner out. However, Warren soon realized that the company he had purchased was declining and that his investment would soon be wasted. This led Warren to take a very important step. He transformed Berkshire Hathaway from a textile company into a holding company. Berkshire Hathaway was a dangerous investment for Warren, and it forced him to change his investment philosophy. This is where his business partner, Charlie Munger, enters the story. Charlie gave him a crucial piece of advice: buy fair companies at wonderful prices, and buy wonderful companies at fair prices. Using this philosophy, Warren began buying large shares of top-tier companies like American Express and the Washington Post, whose stock prices soared from $1 to $290 by the late 1970s. This strategy proved highly beneficial for Warren. Then he entered the insurance business. He noticed one important thing: insurance companies operate just like banks. People regularly pay premiums, so these companies always have a large amount of money on hand. Because of this, starting in 1967, Warren began acquiring insurance businesses. After earning billions of dollars from these insurance companies, he invested the profits in companies with strong economic moats. To explain economic moats simply, they are the competitive advantages a company has over its competitors. These advantages might include patented technology that competitors don't have or that would take years for them to develop. With this strategy, Warren purchased 7% of Coca-Cola's stock. After this strategic investment, Berkshire Hathaway's portfolio skyrocketed. Warren continues to follow this strategy even today, with recent investments in Goldman Sachs and Bank of America. As of today, Berkshire Hathaway is one of the most profitable and powerful companies in the world. In 2008, Warren was the richest man in the world. However, despite having so much wealth, he still lives a very simple life. He owns a modest house, drives a simple car, and enjoys spending time with his family. Warren has also pledged to donate 99% of his wealth. If you calculate it, he has already donated about $40 billion, making him one of the greatest philanthropists. This is a key trait of a great businessman. He not only focuses on his own growth, but also ensures the growth of others. So this was the story of the great businessman Warren Buffett. If you enjoyed this video and want to learn more about business, make sure to check out these videos. I'll see you in the next one. Until then, keep inspiring.